Well, folks, the Federal Reserve just dropped the hammer on the stock market. We have so much to get into in today's video, folks. So many stocks to talk about. Obviously, at the top here, we're going to talk about the Federal Reserve. Let me be very clear. As of about 11:45 p.m. in the Pacific Standard Time Zone here today, I said to myself, if I was a short-term trader, what would I do right now? And my conclusion was, if I was trying to play the market from a short-term perspective for the next 1 to 2 weeks, I would have sold every single stock I own here today. I would have sold Tesla, Meta, Palantir, every single position. The only positions I would have for the next couple of weeks would be short positions. Now, I'm a long-term investor, so how many stocks did I sell today? 0 stocks. I'm not a fool. I know that longer term you'll produce far worse results if you were trying to time in and out of the market, but I like to play these little games in my head. And what I heard from the Federal Reserve today is not good. It's not good for the market short term. I can tell you that. It's very, very bad. And so a lot to go through in today's video. So many stocks to talk about. It's an action-packed video. I mean, it's always an action-packed video, but this is a whole other level of action-packed here today, folks. So many stocks to talk about, so many things. It's ridiculous. Okay, I appreciate everybody joining me as always. Thank you for being subscribed. A lot to get into, and let's get straight into it. So there's 2 critical things that the Federal Reserve basically said here today. Okay, there's only 2. I watched the entire Jerome Powell press conference, every single minute of that thing. Okay, so only 2 things out of that whole deal you really need to worry about or think about. Okay, the first was this. Okay, they didn't raise rates here today. They're going to remain data dependent, and they left the door open for future potential raises. None of that comes as a surprise. Everybody pretty much knew that, okay? Everybody knew they weren't going to raise rates here today. Everybody knew they were going to talk about they're still data dependent. They like the way things are going, but they're not, they're going to remain open to the possibility of future rate hikes. We think we're at the more of the end than the beginning. Everybody knew that. Everybody and their great grandma knew that, okay? There was no news. But that's what the market actually got caught up into at first, because the market was rallying off this. And I'm just sitting back just laughing, because I'm just like, this is such a joke, man. Like, literally the news came out and then the market's rallying. I'm like, yeah, okay. Nice one, okay. The second part is what actually matters. And this is extremely troubling if you are bullish in the short term, okay? This is what happened. The Federal Reserve basically said they're likely going to keep rates 5% plus through 2024. Now, why does this matter so much? Okay, we're going to get into that in just a moment. But here's now the Fed dot plot. Here's what we're looking at. Most members now are expecting 5 to 5.5% through 2024. Now, at this point in time, that just threw a huge bucket of cold water on all the folks that had expected the Fed to start lowering rates in 2024. And, the soft landing is going to happen and the economy is going to stay great, but then the Fed is going to lower rates and it's all going to be smooth sailing here, okay? So basically, if you are playing a little higher level game of chess, okay, you got to ask yourself, what did the Fed just tell me today that they can't really say, okay? What the Federal Reserve just said is basically, in my opinion, they didn't come out and say this, but this is my opinion, and I think smart money picked up on this later in the trading day, and that's why you saw the massive sellout of stocks. Basically, the Fed just said, we are not going to lower interest rates in 2024 unless we see a major recession coming. Unless we see economic data starting to get really bad, rates are staying high. That's troubling, right? Because a lot of people had forecasted that, yay, things are going to stay pretty good as far as earnings in the economy throughout 2024, but they'll lower rates. And the Fed basically just said, not happening. We'll lower when we start to see bad economic data come in. And that is very troubling for this market short term, because I think that caught a lot of people off guard in a massive way. The scary part of this is very similar to obviously what we saw prior to the great financial crisis. We had this kind of pause time period that was almost a year roughly in terms of the pause, right? And, we might be going through a pause here over the next few months. Some people think they might raise again in November. We'll see about that. But a lot of people feel like right now we're kind of in a pause period for this next, 6 months or so. And so in that scenario, the economic data started to get bad toward the second half of 2007, and the Fed started lowering rates. By that time, it was too late. The Fed lags were catching up. Next thing you know, we had systemic problems in 2008 and just a massive epic recession into 2008, 2009, obviously, right? Where massive amounts of jobs were lost, and it was an ugly situation. And so that's the scary part of what could be setting up here, okay? So that's the Federal Reserve part there. It's important to understand that. Okay, now let's start talking about stocks. Let's start getting into the market in general and kind of, move from here. But this was the fake out. Okay, I was just, like I said, I was just sitting back laughing at that. That was the fake out of the century that the market was doing. It was rallying, and I'm just like, give me a break. And then sure enough, the Dow tanked, hundreds of points into that last hour of trading. Okay, now in regards to a lot of stocks, we got a lot of things to talk about in regards to news in relation to a lot of stocks, a lot of important things going on for a lot of very important companies that a lot of you guys probably are shareholders of. Okay, elf on a shelf down huge again today. Obviously huge growth stock here, and this stock can't do anything right now in terms of stock price. Down another 6% here today. This was just after yesterday's massive move. Remember, I covered ELF yesterday and then massive move down in ELF yesterday, and then another one here today. Another one, as DJ Khaled would say, right? I mean, yeah, we're still sitting on great gains in regards to ELF, and I think ELF's long-term future is very bright, but there's no doubt that the short term is brutal for ELF. ELF was $140 a share just a snap of fingers ago, and now the stock just continues to push down day after day after day. Palantir stock. Oh, Palantir. Well, this stock fell about 2.7% back into the $14 range here today. Hearing what came out of the Fed here today is not the best thing when it comes to longer duration assets, such as Palantir. But do remember, when it comes to Palantir, this kind of benefits them, I think, pretty well, because think about it, right? If the Fed's going to keep rates higher for longer, well, guess what that's going to mean? That's going to mean treasuries are going to yield higher for longer as well, okay? Which bodes well for Palantir because they're actually making a bunch of money right now with all the cash they have in treasuries. So, you can look at these things both ways. If you got money in a savings account, if you got money in a CD account, if you own a stock like Palantir that's making a bunch of money from money in treasuries right now, right? What you actually heard from the Federal Reserve today was actually fairly good news for you, at least in the short term. We'll see how it all plays out long term, right? Big recession's not a great thing if that ever comes. Amazon stock saw a downward move here today. We're going to talk about some big Amazon news. Amazon always so smart. Some big news in regards to Amazon later on in this video. Fubo was up very nicely. These are the shares I hold in the public account, right? Fubo was up 4% plus at one point here today, and then what happened? That stock just went lower and lower and lower. And then I saw something really strange. Dividend stocks. Some of these dividend stocks that had been just slaughtered, taken to the slaughterhouse, all of a sudden were performing today. Look at Target here today, green. Cheesecake Factory, green. Texas Roadhouse, very slightly red, much better than the stock market in general. Strange. Very, very strange activity going on there. Look at this stock chart. I mean, this shows all those stocks I just went over. Amazon, Meta, PayPal. PayPal was down 2% today as well. Shopify, Palantir, and then Elf on a Shelf. And look at the last hour of trading. I mean, it just was a clear sell. I think the smart money on Wall Street finally figured out what I had already figured out, like way before that. And then they're just like, oh, crap, man. This isn't good short term. And then it was just an absolute just sell at any price, and there's no buying pressure in that last hour to push up those stocks. It was unrelenting selling pressure. Look at Fubo. Fubo was 285, and then that stock ended up closing at 270. None of these stocks could last in that sort of selling pressure. Look at Celsius Holdings here today. This is a stock that has certainly made some folks a whole lot of money that have been invested in this over the last few years. But Celsius Holdings down over 8% here today. And that's just another one of these high growth stocks that just got pummeled today. Look at the divergence between Celsius and Monster Holdings, right? Monster is obviously the energy drink giant, right? Celsius is an up and coming growth beast. And the divergence was shocking here today. Monster with only a 1% downward move. Celsius at an 8% plus downward move. That's divergence. But let me show you exactly what's going on here and why this happened, okay? Look at Celsius's forward PE. That's shocking. For a drink company, that's simply shocking, okay? As far as based upon this year's numbers, Celsius Holdings is trading at 109 forward P. Now, they've had great growth, so hopefully they can grow into that over time. But my gosh, look at next year. Even next year's numbers, 2024, they're trading at a 76 times next year's earnings. I mean, we're talking about that's, insanely high numbers. Now look at something like a Monster, right? Monster's trading at 36 times this year's numbers and 31 times next year's numbers. Monster doesn't have this sort of growth that certainly a Celsius does, but that just goes to show you if there's a let's call it a movement to safety, or feeling like you start to get worried about the market. Stocks like Celsius get hit the hardest, right? Stock like Monster, not as much damage there. It's a proven business model. They've been so relevant for decades now at this point in time. You're getting forward P's much lower. So, 1% down here today or whatever versus obviously Celsius's massive epic downward move. Check this out. Amazon. Amazing Zon. Some of you guys might own Amazon stock. Well, I can tell you, if you own an index fund, you own a lot of Amazon, okay? Because it's a heavyweight. If you own the Qs, you own Amazon. If you own Amazon, you own Amazon, okay? Amazon scraps merchant fee ahead of expected antitrust suit. Look at this. Amazon is scrapping a planned fee on merchants that don't use its shipping services, Bloomberg reported, citing documents. The reversal suggests the company is being more cautious about how much money it tries to extract from online sellers amid an antitrust investigation. The 2% fee on merchants was set to take effect on October 1st. The U.S. government is expected to file an antitrust lawsuit against Amazon soon. The federal case is expected to focus in part on Amazon's alleged efforts to coerce merchants into using its logistics services, Bloomberg said, right? Smart move by Amazon. I can tell you right now, you just want to kind of lay low, when it comes to Amazon and all this stuff. Like, you don't want to jack up any merchant fees, especially not right now with this potential suit incoming. It's going to be a bad look. Amazon's making the right decision in regards to that. No doubt about that. These companies have become so big now. I think one of the big risks to all these companies that I don't think is factored in nearly enough, folks. I don't think this is factored in nearly enough. One of the biggest risks to Amazon and all these big dogs is the government. No doubt. When you're talking about these companies are now trillion-dollar market caps, multi-trillion-dollar market caps, at some point in time, the government starts to look at them and they say, what are you guys up to? What are you doing here? This is unnatural. And let's be honest, the government needs money. And so it can be a nice shakedown of these big companies. You can hit them with a fine. You can say this, or you can say that, or change this, change that. But at the end of the day, I think it's more of a shakedown than anything, just to be quite honest. And we know the government needs the money. So, you get an opportunity to shake down Amazon, who's got plenty of money. You're going to take that opportunity. I think all these guys, Google's going to be dealing with a lot going on the government front for years. By the way, this is not stuff that's cleared up fast. This is going to be overhangs of these stocks for years to go in the future. So I do think that's important that everybody understands that. This is not like Meta had to deal with this stuff for years. It wasn't like it was here and then, it was over next month. No, this lasted years, folks, okay? So just keep that in mind in regards to these stocks. Now, there's huge news in regards to Apple that's very negative, okay? Check this out. So, Apple Store employees in France are set to strike, clashing with the iPhone 15 launch. What? Workers at Apple stores in France are slated to strike this weekend after their request to raise was not met. In a post on X, formerly known as Twitter, a group of 4 unions representing Apple retail workers said management ignored our demands in asking for a raise. Thus, workers are slated to strike on September 22nd and September 23rd, coinciding with the launch of the iPhone 15. We will remind management that it's not these movements that harm the company, but rather than the denial in the face of discomfort of its employees. According to Insider, the group of unions, which include CGT, CFDT, wants a 7% increase in pay for its employees. Now, Apple France offered supposedly an increase of 4.5%. All right. Now, I'll show you this is almost kind of like a slap in the face by Apple's, let's call it, potential pay increase here, in my opinion. But I think there's a big risk for Apple, and that risk is if this is seen by, I can tell you more folks are going to be paying attention to this, right, in other countries outside of France. And if this works, you could be dealing with a lot of this in the future when big new products are going to be set to be in the stores. Around holiday shopping season, you could see some of these movements happen, right? And at the end of the day, a company like Apple is going to have to pay up. But Apple doesn't want to pay up right now because we know Apple's revenues have been going down recently, right? We know Apple's profitability is if anything, going down here recently. So for Apple, and it's trading at pretty high valuations, I don't know if it's the best time to be dealing with this sort of stuff, but I think they're going to have to continue to deal with this, all these big companies, right? But here's why it's kind of a slap in the face from Apple's offer, okay, and why 7% actually sounds more appropriate. The people of France have been dealing with inflation in the 5 to 6% range for pretty much this entire past year. If you're only going to get a 4.5% raise, okay, 4.5%, you got a pay cut, not a pay raise. If everything on average is 5 to 6% more, 4 to 4.5% is not even cutting it with inflation, okay? So you're making less this year than you made last year, even if you get a 4 point. So that's why 7% makes like actual some sense, right? So 4.5% would be fine if inflation was 3% for the people of France over this past year, okay? But that's not a pay raise. And so we'll see how this translates, but this is where you get into the ugliness of inflation, and this is where you get into the ugliness of potential stagflation. And this is why it looks inevitable that at some point in time you need a recession, because it seems like it's not working for Apple, and it seems like it's not working for the workers either, right? This whole dilemma. This is a dilemma that folks are dealing with right now, and it's not a good situation at all, okay? Now, people are getting also screwed in other ways out there. These IPOs are a joke, okay? Absolute joke. People are getting played hard with these IPOs. You guys see Instacart here today? Down a bunch more. I mean, by the time retail could get in the stock, it was $40. The stock today is $30, okay? If the market's down tomorrow, what do you think Instacart's going to be? 27, 28, 20, you know, I'm sure some insiders are going to try to save this stock to save some face here, but it's not looking good, okay? And that's not the only one. Look at ARM. ARM was down another 4% plus here today. After hours is down another 1%, right? And this, has ARM even had a positive trading day so far since IPO? Like seriously, that's a real question. I don't think it has. I think pretty much every day ARM has been down since that day IPO started, right? And just like people getting played in the situation hardcore. This VinFast might be the worst of all of them. Have you guys seen this VinFast stock? Let me know in the comment section if you've seen this stock and what you guys think about these IPOs. I'd love to hear your guys' opinions and perspectives in that comment section, okay? This VinFast went public recently. As of August 28th, which is less than a month ago, right? The stock was trading $80 plus. Today it's $17. $17. It was $80 plus less than a month ago, okay? This is a joke. This is not Q1 of 2021. This is not the time for these IPOs, okay? And whoever thought this was a good idea to take these kind of, in my opinion, very questionable companies public, I'm like, who needed to cash out? That's all I'm wondering. Who needed to cash out? How bad did Wall Street need to do some deals? Because this is not the time to be doing these IPOs. I'm just telling you, it's not it, okay? We're not in nearly of a strong enough financial cycle right now to be having these sorts of companies go public that are very questionable companies. I can tell you that, okay? Check out Cava Group. This is supposed to be the next Chipotle, right? But in the Mediterranean space. This stock was down almost 5% here today. This stock, everybody was so excited about it a month ago, less than a month ago. $45 stock is $31 here today. And don't be surprised that this Cava continues to have troubles. I mean, if the market's going down, this Cava is going right down with it, and it's going to go down a whole lot harder than the market in general. This is not the time for IPOs, folks. We're not in that sort of time period, okay? Eventually we will. Eventually it'll be time for IPOs again. I'm just telling you, they got tricked. Well, you know, everybody got tricked. They thought, oh, the NASDAQ's going up this year. It's been having a great year. Look at the Qs. So that must mean it's a great time for IPOs. No, okay, that's just recovery. That's AI excitement plus recovery from how bad those stocks got hit last year. And those real business models, let's be honest. Cava Group, VinFast, Instacart, all these other jokers, ARM, these are not Apple. These are not Microsoft. These are not Meta. These are not Amazon, okay? These are not Tesla. These are not the best of the best companies in the world. These are not the sort of companies that are finding ways to make profits in any sort of environment. These are very questionable businesses at best, okay, on several fronts. So that's going on there. Yeah, don't get sucked in that whole IPO crap, okay? They got another one. They just took another one public. Oh my gosh, okay, this Klaviyo, taking this one public, okay? And then they always say, oh, it popped. But a lot of times, by the time retail can buy these stocks, they've already gone down considerably. So it's like, oh, the stock was up 10% in the first day of trading or 20% or whatever. But then you look from where the time retail could get in, and the stock's down like 10, 20, 30%. They just don't cover that, okay? So, okay? Now, we're having trouble even with stocks that have been public companies for quite some time. Chewy's a great example of that. That stock was down over 5% here today. Chewy stock is getting obliterated right now, is the best way I could put it. Absolutely obliterated. This stock was $40 earlier this summer. The stock's $18. $18.36 after hours right now. $18.36. It has dropped over 50% in just the past 2 to 3 months. This is a disaster, folks. And remember, a company like Chewy is seen as, oh, they sell pet supplies. No one's going to cut back on pet supplies. Everybody loves their pets so much. Ooh, really? Well, we'll see how that works out. Look at this. Chewy dips after Oppenheimer says pet spending is finally showing signs of cracking. Oppenheimer downgraded Chewy stock, CHWY, to a perform rating on Wednesday after having the online pet retailer as an outperform. Interesting they move it down after the stock's already crashed like 50% in the past few months, right? Great job, Oppenheimer. You were really ahead of that one. What a joke. Analysts, I won't pronounce our name, said the following disappointed commentary from Chewy on net adds in the recent pullback in shares. The firm spent time revising its investment views on Chewy. After the stock had fell like 50% in the past few months? Okay, now you're going to okay, interesting. We expect a more challenging backdrop to persist for at least the next few quarters amid recent signs of weakness in the historically resilient pet food category and potential for more muted inflation benefits in fiscal year 2024, January 2025. In addition, we believe that the current higher rates backdrop represents another pressure point for shares. Before we go further into this, okay, let's be clear about this. People did not really start spending exorbitant amounts on their pets until really like the past 10 years. I mean, this was not normally a thing. Pet food being resilient and those sorts of things, folks, okay, in the great financial crisis, people weren't going out there and buying fresh pet and all this other stuff where they spend, as much money on some of their pet food as they do human food. That's crazy, right? They weren't. I mean, they were buying, people still got to buy stuff for their pets. They still got to buy the pet food. It's just people have way leveled up the level of spending over this past 10 years or so. But what has else been in common the past 10 years? Well, a good economy, super low interest rates, a good, real wages that were in a good place for much of that until really the past few years, right? And now all of a sudden, real wages haven't been the best place the last couple of years. Inflation's hit hard. Now interest rates have gone back to more historical standards, and look what's happened. Now all of a sudden, folks that, might not have been as good a financial situation as they were in the past are saying, hey, my pet can eat this food instead of eating this food that's as expensive as going to, dang Panda Express or something like that, right? So that's what we have going on now at this point in time. Oh, to finish out this note here, right? The analysts and the team reduced fiscal year 2024 forecast on Chewy to primarily reflect the potential for minimal pet food inflation, uncertainty in the net adds front, and expectations for increasingly promotional backdrop as industry growth moderates. In addition, the analysts expect basically an aggressive Chewy management investment agenda to continue into fiscal year 2024, right? Now, I gotta say, I'm going to have to do a deep dive on Chewy. It's getting to levels that could be interesting, right? Chewy is, at the end of the day, it is a growth stock, and it is a stock that, valuation's gotten somewhat compelling very recently, right? We're talking about 33 times this year's numbers, about 29 times next year's numbers. So I'm going to have to do some digging in Chewy. Maybe there's something here. I already own Amazon. Amazon obviously has big exposure to the pet industry, but obviously Amazon is such a massive conglomerate that it's just one component of that, right? And they also own Whole Foods. Whole Foods sells some, let's call it, pet foods and things like that. And it, definitely caters to the higher end consumer. I also own Target stock. Target has fresh pet in the Target stores, and also a lot of people like to shop for their pets at Target. So I already have exposure from really two stocks directly, obviously Amazon and Target. So the question is, would I want a third stock and one that's dependent upon pet-related things? I don't know. I'm going to do some digging there. I'll see what I find, but it's a potential. I'll call it that. It's a potential, okay? Now, in regards to some of these big tech stocks here today, the few moves that caught my attention and my eye, folks, Intel was the worst stock yesterday. It's the worst stock here again today, down 4.5% here today. 4.5% for Intel. Google McDougal down 3%. Okay, Google, guys, I'm just telling you, Google's valuation kind of looks a little attractive, but I do worry that Google's a value trap, folks. I'm telling you, YouTube's not in the best place right now. I've got to go in depth at some point in time. Maybe it's on this channel or Reaction channel and explain to you guys what's going on at YouTube. It's not the best. Okay, as somebody that's been a fan of YouTube for the past, 15 years, and somebody that's been on the platform since 2016 when I started my channel, right? I can just tell you, things aren't great at YouTube. They have many problems on many fronts at YouTube, and I gotta eventually go into detail and everything that's going on there so everybody understands. But the main other thing for Google that's really a holdup here in the short term, meaning over the next year or two, is they got big problems with the government. Their legal fees are going to be astronomical. They could potentially face fines. They could potentially face changes to their business model that would not be good for their business model. So, Google, there's a potential that Google could be a value trap where it's like, oh, it's P's, look, oh, it's so fair, but really the stock goes nowhere over the next few years. We'll see, okay? NVIDIA caught my attention, now down to 422. Could this stock push back into the 300s? That would be pretty crazy, okay? Shopify continues to get hit day after day after day with a move out of these growth stocks, right? Even Mr. Softy got hit. Oobity Booba stock got hit today as well, right? And I pulled up my Cathie Wood watch list here today, did a video on the reaction channel in regards to a new Cathie Wood interview here today, right? And I was kind of looking at this Cathie Wood watch list, man. Square stock is just getting brutalized, right? Down another 4.4% here today. It's down to $47 a share. This is, is there anybody that's willing to buy Square stock right now? Like literally this stock is just getting pummeled day after day after day after day right now. And I don't know what's going on. Like Cash App is still a number one finance related app pretty much on a daily basis from what I see on the iOS store and in general. But man, Square is just getting brutalized right now. So I don't know. At some point, could I buy Square stock? Probably not, because I'm already have been buying so much PayPal, and I'm going to continue to buy so much PayPal for the next few months. That do I really want exposure to Square and PayPal? Not really. But gosh, man, that one's even getting intriguing now at this point in time, right? I saw Exact Sciences was down pretty big. Roku's down big. Unity down again here today. Unity just can't get out of its own way. Coinbase down as well, right? Commodities I care about. We did get some good news on the commodities front here today. WTI pushing down. So if you're wondering, is there any good news that comes if the market, let's just say, hypothetically, the market goes down. Let's just say over the next few weeks, everybody gets caught up into all this Fed stuff, right? Oh, the Fed's going to keep rates high all next year. That gets rid of the whole possibility of soft landing with Fed lowering rates, and the Fed's not going to lower rates till recession, okay? So let's say that weighs on the market heavily over this next few weeks. And let's just say there's a sellout of a lot of stocks, just a lot of selling pressure over this next few weeks, okay? There's a really good thing that comes with that other than being able to pick up stocks for deals, okay? The other component that's really good in regards to that is that will push oil down. That will push commodities in general down, okay? If you're talking about S&P 500 goes down, NASDAQ goes down, you can see a sell-off. Commodities will go down as well. Oil price follows these commodities around, okay? Oil prices being able to have a really good, year this year. Why? Look at where the Qs have gone this year. Look where the NASDAQ's gone. Look where the S&P 500's gone this year, right? So take all that into account and you can understand why oil's had a good year, right? As much as they say it's about supply and demand and, this country's going to produce this much and, there's going to be no recession. And as much as it's about that, I'm just telling you when it comes to the price of oil, it's also about risk on or risk off. Risk off, no one wants to hold oil. Risk on, everybody wants to hold. Look at the market. We were in a very risk-on market 2013 into 2014. Look what oil price did during that time. Everybody and their grandma wanted to start a dang oil well out in Texas. Okay, it was ridiculous. And in North Dakota. And then look what happened when the market started to soften, the stock market that is, and the financial markets in general in 2015, 2016. And look what happened to the oil price. Okay, I'm just telling you, as much as these guys are going to talk about supply and demand dynamics and the whole other stuff, it's so dependent upon risk on, risk off. Kind of similar to Bitcoin almost a little bit, where it's like, if everybody wants to take risks, they kind of flock to that asset. If they don't, you see a sellout. There's a huge correlation between crude oil and the stock market over time. Pull it up over the last 10, 15, 20 years. You'll see exactly what I'm talking about. Look where oil price went in, the back half of 08 and into 09. Look where that oil price went as the economy tanked and the stock market tanked. Oil tanked right along with it. Oil can have a few divergences here and there, but I'm just telling you, over time, this is one of those good things. If you want to root against the market short term, you get stocks for better prices, and you get crude oil to go down, which, let's be honest, if crude oil comes down, gas prices go down, which is a good thing for consumers. Also, simultaneously, that's going to help massively with CPI in the wintertime. So, if anything, guys, root for the stock market to go down short term, okay? It's a smarter idea than rooting for this market to go up over this next few weeks or few months, okay? Keep that in mind, what I just told you there, okay? Now, you know what's something I thought was interesting? I'm starting to get emails. And I'm starting to get emails from the fancy resort companies that I've visited in the past. And this is something that's new. I can tell you, I haven't really gotten any promotional emails from any of these companies for like 2 years, if not longer than 2 years, okay? And the reason being is I think a lot of these places were, obviously booked up heavy. But there's a potential that some business is starting to come in a little softer for some of these guys. So I've noticed very recently, all of a sudden I'm receiving some of these offers. Oh, get 15% off rooms. Oh, get this, get these credits, get this and get that. Which is actually a more normal environment. Usually you get these type of promotional emails from these guys. It just seemed like a lot of them for the past 2 years. Why would you do promotions? Why would you give any discount if demand was insane? Just think about that for a moment. If demand was insane, why would a high-end resort discount it all? You wouldn't. It doesn't make sense. But if all of a sudden traffic to your website, room bookings start to decline a little bit, those restaurant bookings aren't quite there and everything else, next thing you know, you start emailing your customer base. I haven't been to this place in years. I had dinner there years ago, and now all of a sudden they're hitting me up with these offers? Yeah, you're really going down that email list there. That's intriguing, right? So, a couple things you need to be doing right now in this market, okay? One, take advantage of these deals. Be aggressive this next 6 to 12 months. This is definitely a time, in my opinion, for the next bit of time here where aggressiveness is going to come back into play. Which last time it really made sense to be aggressive was actually the third quarter, fourth quarter of 2022. It was a great time to be very aggressive. I was ultra aggressive buying growth stocks left and right. You guys know that, right? I think I bought, $77,000 in Meta in like a 24-hour period or something ridiculous, right? So you're definitely going to want to be on the more aggressive side for this next several months and taking advantage of a lot of good deals you're going to get out there, right? A lot of these stocks are already heavily discounted. They could definitely become more discounted if there's a lot more fear that the Fed's going to be higher for longer, okay? And so you definitely want to be able to take advantage of that, regardless of recession, no recession, hard landing, soft landing, medium landing, whatever landing happens, make sure you're taking advantage of those deals out there, okay? Mega cap is where I'm kind of like, I don't see the best values there. I don't see the best deals in mega caps at this point in time. Mega cap deals are kind of meh right now. You're not going to see me plowing a ton of money into the mega caps. I already got good exposure there on many stocks like Meta, Tesla, Amazon. So I don't think that's where actually the best opportunities are. I think it's underneath a lot of those stocks, a lot of dividend payers, a lot of the more growth value names that are, let's call it in that kind of, we can call it $30 billion to like $70 billion range. I think you get a lot of opportunities there, okay? And the second thing you got to do, expand your knowledge and expand your network right now. Like this is definitely one of those times you want to be putting in the work and finding out if you don't know everything there is to know about stocks and investing and how to value these companies. It's definitely a great opportunity to go ahead and take advantage of that now, okay? My Financial Fortress program teaches you everything you could ever want to know in relation to investing, from financial statements to valuations to running portfolios and everything in between. So if you want to take advantage of that, get access to all that, plus be part of the Discord chat we have in there with, hundreds of 6-figure members and a ridiculous amount of 7-figure plus members, meaning you got $1 million plus in your portfolio, then check out pin comment down there, apply to join us in there. Much love as always, and have a great day.